Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. Welcome back to the podcast. I'm Barry Schwartz. I'm joined by Ernest Wong, Head of Research at Baskin Wealth. Today is May 14th. Thank you for making time to listen or watch this podcast. We really appreciate all your support. We got an exciting show today. We're going to talk about the Constellation Software annual general meeting, as well as cover a few other companies in our portfolio and talk some general market stuff. So before we get into that, let's get into this. If you like this podcast, please subscribe to it on YouTube, on Spotify, on Apple as well. You know what to do. Give us 5-star reviews. Give us a thumbs up. Might help, might hurt, but hopefully it will help. And of course, if you know anybody that could use any of our services, Baskin Wealth Management has been in business for over 30 years. We have a strong portfolio management team, and we help our clients with all stages of wealth and financial planning. So please reach out. Ernest, the Constellation machine starting to slow a little bit in the first quarter. The market pulled back a little bit on it. But Constellation will say, you know, we're in a lumpy business. Sometimes deals just don't show up. Sometimes the deals are pick up more often in a bigger market. I think, of course, probably something that's no one's talking about is the fact that with all the uncertainty about the tariffs and the economy and what's going on with Trump, I don't think anybody wants to be so active making deals right now. I'm not saying Constellation is the one that's slowing down on deals, but maybe sellers are just waiting for, a clear outlook as to what's going to happen. That could be part of it. But we're going to get into that, as well as some interesting things that Mark Leonard and his team said at the annual general meeting. We saw Mark Leonard looking pretty spiffy with a long gray beard. Gandalf, the wizard of capital allocation, one of the best. And of course, last week, I hope you enjoyed our podcast last week on the Berkshire Hathaway meeting, as well as the announcement of Warren Buffett stepping down as CEO, one of the greatest of all time capital allocator. But Ernest, there's still a few good capital allocators left. We're going to talk about a few of them today, including Bruce Flatt and Mark Leonard. So with that, let's just dive right into Constellation Software and what they had to say for the first quarter, as well as their annual general meeting. Ernest, you listened to the conference call. You made some notes from the meeting. Let's get into it.
Yeah, so Constellation doesn't do quarterly earnings calls like the way that Google or Apple or most normal companies do. They usually just have their quarterly release where they, highlight the financial numbers that they're forced to disclose to the regulators.
Without any best quarter we've ever had or record quarter or we're so excited about the future, they leave all that fluff out. It's just, here's the numbers, here's how much revenue we had, here's how much free cash flow we had. If you want to know more, read our management discussion, do your own due diligence instead of us telling you if things are good or bad.
Yes, that's right. And so basically the only time that you get to see how the management is thinking about the business is through the AGM, the annual general meeting, which is kind of like Berkshire in the sense that they host it once a year. For Constellation, it's now online.
They used to host it in person. I guess they shut it down during the pandemic and have stayed off online since then.
That's right.
How you went to a couple of the Constellation meetings in person pre-pandemic?
Yeah, back in the day.
How many people showed up versus a Berkshire meeting?
It's a lot smaller than Berkshire. Constellation didn't have enough people to fill a stadium.
Yeah,
but it's still quite a few.
I think one of the other other guys who fills a big room is Prem Watsa's Fairfax.
Yeah.
They do their annual general meeting. I think they've been doing it for years at Roy Thompson Hall, which is a symphony concert center, and hosting a whole day event very similar to Berkshire Hathaway. But Constellation, very much less promotional.
Yeah. So like most companies, their AGMs are fairly routine and fairly administrative in nature, where you're forced to, like, the board has to ratify like the auditor, the financial statements, and then takes like 2 minutes, and then it's over.
Okay.
I think most of
me.
the vast majority of the AGMs of the companies that we own, like, we don't even participate or even listen in, because you're not going to learn anything from it.
Yeah. A lot of them, do they take questions from the audience, or it's rare? It depends.
No, so I think the benefit, like, there are these mega event AGMs like Constellation and Berkshire and Fairfax, and there's probably a couple other
Markel,
ones.
I think, does a Markel brunch.
Yeah.
Yep.
Where those are a little different in the sense that the chairman and the CEO and the management are there to answer questions about the business and kind of talk about things that they're doing. But I think there is also value in attending, like, individual AGMs of some companies where other people don't go to. So, like, last week, I went to an AGM of another company that we own. I was the only person who went. There was a couple of the board members there. I got to talk to the chairman for half an hour afterwards and had a really good discussion. So I think those are the kind of things that that we try to do more of in the research process.
Okay.
But with regards to Constellation specifically, I think this is a really smart way, and I really appreciate that the format of a 2 or 3 hour long Q&A with the management, instead of the quarterly, like the 4 times a year quarter earnings call.
Yeah.
Because you don't have, for, like, most of the questions every quarter is like, well, why is your guidance up 1 or down 1 or 2%? Like, how is your revenue trending in April versus your original expectations? And kind of what we call modeling questions, related questions.
So it's not necessarily long-term investors. It's analysts preparing their analyst reports for the investment bankers, and as well as the street, to try and model what the next quarter is going to be like. And that's the incentive for them. It's short-term trading. It has nothing to do with long-term investing. And although some of them may point out some long-term things that are going on, it's really about, are they going to beat earnings the next quarter, or the next quarter earnings going to be light? And so it's not helpful whatsoever about what's the management thinking, what's their long-term goals, what are they changing, how are they reacting to these situations. And so the 2 to 3 hour Q&A really, if there's good questions asked, can flesh out a lot of what you're looking for.
Yeah. So at the Constellation one, it's, well, first of all, the company is selecting the questions to answer. So it's not an open the floor type format, but they really focus on the big picture questions that the company is facing. So their capital allocation strategy going forward, what are they seeing with regards to competition for deals? Are they seeing impacts from AI on the business? These are the kinds of things that the management is given a large, they're able to answer these questions in extensive detail that you would also not get in a quarterly format.
So the worries that people have with Constellation Software, now that it's $100 billion Canadian market cap company and grown so tremendously, is A, can the growth rate still compound at high levels? B, are they facing lots of competition for making acquisitions? Have they picked off all the low-hanging fruits, so to speak? And see, if that's the case, where do they get growth from next, right? And finally, of course, this AI thing. AI, now that AI can write code, and we're seeing lots of big tech companies lay off people and replacing them with AI, and more of that to come. How does Constellation and its mission critical software fit in to the world of new AI, and is it going to displace or disrupt what it's trying to build and do for its clients, and is it going to disrupt its business model? I think those are probably the 4 key concerns that long-term investors have.
Yeah, and valuation of the stock.
Value. Oh, right. Let's not forget. Yeah. Although valuation to me should be like at the bottom, right? Unless if you think the business is going to continue to compound at high rates of return, valuation for long-term investors is less important. Always important, but less important if you believe that the future for the company is going to look better than the past.
Yeah, so let's go in order.
Okay.
So the first area of questioning for Constellation is their ability to continue to compound and do deals going forward.
Yeah. So the first quarter, revenues were, I think it was the lowest quarter for revenues since the pandemic.
Revenue growth.
Revenue growth, correct.
Not revenues.
Not revenue. Lowest revenue growth. Nothing wrong with revenue growth. I mean, 13% revenue growth. We'll all take that. So that was the issue. So that, I don't know if it was surprising to a lot of investors who've been following the Constellation story, because Q1 there wasn't a lot of deals completed. We'll let you continue.
Yeah, I think that's just. I think one of the things to that as Constellation gets bigger, and they talked a little bit about this at the AGM, is that Constellation's bread and butter is doing small to medium-sized software businesses, and they can do, I don't know, give or take $200 million of these a year. But as Constellation gets bigger and they're compounding off a larger amount of capital that has to be deployed in every year, they have to make up the difference by doing larger deals. And not only doing larger deals, but how should I put this? They're doing deals that are not traditionally the types of companies that they're looking for.
So let's unpack that for a second. So Constellation Software is it poised to do about $2 billion a year of cash flow now?
Yeah.
Give
or take.
Give or take.
Yeah.
So it's a company that's going to do $2 billion of cash flow. 10 years ago, it was doing a few hundred million. Right. So if you understand Constellation Software, this $2 billion of excess cash flow that it generates doesn't go back to shareholders as dividends, doesn't go back to shareholders as share buybacks, doesn't go back to the balance sheet to sit and earn interest like Warren Buffett's doing.
Yeah.
It goes to reinvest.
Yep.
And now that you are a $2 billion free cash flow company, buying 100 small companies where they have $2 million of revenue still leaves you with well over, close to $2 billion to still reinvest in other companies, right? So it's just, how do you invest that cash flow fast enough and still, have the benchmark of, I still want to achieve great rates of return on what I invest.
Right. And the management was quite honest about the fact that the quality of the companies that they're looking at today are not what they used to be. So back 10 years ago, they would be pure vertical market software companies that have very strong recurring components in maybe a developed market like Europe or North America. Mm-hmm. And these are high quality businesses with sticky recurring revenues that they can compound cash flows going forward.
Yeah.
Today, the types of deals that they're looking for have evolved a little bit. So these might be businesses that are a little bit less recurring in nature. So maybe a hardware component, or maybe some more software or support revenues. They might be in geographies that they're a little bit less comfortable with than historical. And especially for large deals, they might require a lot of work. And you're seeing that with some of the large deals that they've done, such as Altura recently, that have been dragging on overall growth rates.
Yeah, even though it was well articulated to the street that this large deal that they made is never going to be a home run, a grand slam, but it's going to be a home run in terms of how much cash we're putting in, how much cash flow we're going to take out over the long term. It's going to earn us great returns, but it may be a drag on, because it's so big, it's going to be a drag on near-term results quarter to quarter.
Right. Yeah, that was... So I think the important thing to understand about these deals, though, is that they're still earning a good rate of return on it, because I think they spent $400 million buying Altura. It makes Constellation as a whole's organic growth look really bad because it's declining like 2, 3, 4, 5% a year.
Yeah.
But
I think it had a minus 13% organic growth or organic loss of revenues the quarter. So it really dragged down the quarter for Constellation.
But importantly, like, the declines were something that they had modeled for when they bought when they did the deal in the first place.
Yeah.
And they're still earning, I want to say, about $80 million of free cash flow a year on a $400 million acquisition.
Sounds good
So
to me.
it's
20%
pretty
return
impressive,
in cash on
pretty
cash.
impressive cash on cash.
Yeah.
So that's kind of where Constellation is.
So getting back to the question of can they compound, and is the growth still there? I guess what we're trying to say is the growth is still there, but it's not going to be at the same rates as in the past.
Yeah, and increasingly going to be outside of traditional VMS. And they have been trying to think of ways to and look for alternative businesses that they can get into and that they can continue to deploy capital in.
Yeah.
So the most kind of fun, humorous example is that I think they looked at an oil company before. When oil was negative. They didn't end up doing it, but
that would have been a home run.
Yeah, but I think that the thing to understand about Constellation is that the main purpose of Constellation is to earn good returns on capital. It's not just to operate a good software business.
Correct.
It's to make money that is in excess of what they would get from the market. And they're going to look for ways to do that, whether it's in software or in whatever else they find next.
That's right. Constellation's management team have studied what they call high performance industrial companies. A lot of these serial acquirers of industrial businesses, whether it's Amitech or TransDigm, Illinois Toolworks, Jack Henry, Roper, you get the point. Is there are still millions of companies to acquire that generate high cash flows. It may be in businesses where there's a high barriers to entry, where there's maybe the only competitor or the only product or service. So you really have to think of Constellation Software as I think you put it perfectly. Its whole business is just to reinvest that cash flow. Don't think of it as a software company. Think of it as how can it grow outside. And you got the smartest people, bar none, operating this business. So I'm excited to see where the next leg of growth comes from. But I think they're prepping people for it. It's going to be outside software, guaranteed. Wherever it's going to be, whether it's testing or aerospace parts or God only knows, right?
Probably won't be aerospace parts because there's already companies doing that.
Yes,
but I think they're going to. I think at the end of the day, it comes down, and this is kind of applicable to Berkshire as well, comes down to whether you trust the management for their ability to run the business and to make capital allocation wisely.
Yeah. And okay, let's say, thought experiment, the growth does slow and there's fewer and fewer acquisitions to be made. Maybe Constellation becomes a high returning vehicle of share buybacks and dividends, right? Anything's possible in the future.
Dividends probably not, right? Because one of the things that that Mark Leonard has always talked about is that paying a dividend to shareholders, and Berkshire has the same attitude as well, is that if you pay a dividend, the shareholder has to pay tax on it
immediately,
and you very likely have less opportunity to reinvest the cash that you received into anything close to what Constellation is earning, even if at a lower hurdle rate.
What would be the red flags for you to be concerned about Constellation and its growth rate? Would it be if the organic growth rate of its current business goes negative, or is there anything that you would say this business model is broken?
Yeah, I think it's an interesting question because sometimes there are companies that have such a good track record and have done such a good job for such a long time that even if they go through a rough stretch, you're inclined to give them the benefit of the doubt that they're going to figure it out. And so I've certainly suffered from that from some companies that I've owned where they've had a brilliant track record of capital allocation and they didn't do anything for a while and the stock didn't really do anything. And and it lost its halo as a brilliant acquirer.
Yeah. But sometimes these halos can come right back, right?
Yeah. Mm-hmm. So I think if there was an extended period of time where the cash was just piling up on the balance sheet and they were not able to do deals, and it didn't seem like they were really thinking too hard about this issue, that might be something to think about.
Okay. So we covered that. So I think expectation is Constellation may not be able to grow 25 or 30% a year going forward.
No, but I think no, but again, like what gives me comfort about Constellation is that they're at least thinking about this problem. Like most companies will not even
It's a good problem to have, by the way.
Most companies are not even going to admit to you that like they are going to slow down their growth from acquisitions going forward. Like they're not even thinking about this as an issue because you're just naturally not wired to admit that your growth is going to slow down in the future.
In the meantime, of course, that was Q1. In Q2, it looks to be a very strong quarter for them allocating capital. And also, the spinoffs seem to be working tremendously, right? The incentives at Topicus and now Lumen, which are separately publicly traded companies, they've been growing fast and more active on deals, right? And so one can imagine that if Constellation sees more slowing growth at the parent, maybe it will be more inclined to spin out more of its divisions when deals make sense, right? So lots of levers for them to pull to encourage growth.
Yep.
Okay. So what's the next concern we talked about?
So AI was the other one that I think people had some, there was some discussion about whether AI was a risk to Constellation's business, either in the sense that most of his business is pretty small software businesses that not anybody, but it's not too hard to spin up a copy of that using AI today.
Okay.
And so, as you would expect from Constellation, they've spent a lot of time thinking about this issue. And it was I thought it was a very thoughtful discussion where they admit that, this is a big thing. They're paying attention to it. They're studying it in terms of how it might impact their business. But the types of businesses that Constellation typically owns is not just a piece of software that you download from the internet and then you run it. It's often it requires a lot of expertise in the customer that you're selling to. There's a lot of training that's required.
A lot of customization.
A lot of customization. It's often very integrated into the process of the business. So the example that they gave is the pulp and paper industry, where they sell software to the pulp and paper industry. There might be about 40 pulp and paper plants, customers for this end market. And the software is very deeply integrated into the solution. They know all the customers. And it would be very hard for an AI. So if you were thinking of using AI to disrupt an industry, that would not be the first place you go to. Because there's not many customers. It's hard to get a foot in the door. And you probably wouldn't be doing a better job than what Constellation is doing in the first place.
AI software is probably first going to try to attack the very large verticals like the Excels of the world. We saw today there's a company trying to get funding for AI, legal to challenge Thomson Reuters possibly, right? So you may see them attack large markets instead of these really, really niche-y type businesses like pulp and paper or mom and pop gyms, or I don't know, we'll call it laundry, dry cleaning software, whatever it is. It's not huge market software where people are going to be underwriting a lot of financing for it, risky to break in.
And so with the pulp and paper customer, for example, I think Constellation said they view AI as an opportunity because they have the customer relationship, they have the software in place, integrated into the companies already, and they can actually use AI to roll out improved services to these companies
and maybe sell them more stuff.
Right.
So the whole Microsoft thesis of being able to continually to add new products and services to the existing customers is amazing, right? And so if upgrades and rewrites of programs can become more efficient, as well as possibly upselling some other software and services, this could be a boon to Constellation. There's, your brain can go in two directions here. You can imagine a world where AI just writes its own software and boom, it's done. And you don't need to pay anybody for softwares. You just tell the AI what to do. And then there's another way, like that's too simplistic thinking. And how do you train everybody at your firm? And how does it integrate? And how does it all work? And who's overseeing it? it may take a long time.
Yep.
This may be where the future of software goes, but it may be in 5, 10, 15, 20, 30 years, right? You gave the example of, streaming is taking over the TV right now, but still people pay for cable.
Yep.
A lot of people still and how long has streaming been around for?
Right.
A long time, right? So it can take a while for these trends to really be disruptive. And I think we applaud Constellation about that they're thinking about this, but they're not slowing down their business model whatsoever. Nothing has changed. They're not lowering their hurdle rates. They're not talking about changing their business model, but they're looking for tweaks. And I think this is the first real acknowledgement that that they have reached a certain peak or plateau in their current business model, and they'll have to figure out a way for the next leg of tremendous growth if that's the case.
I would push back on that.
Yeah,
I don't think that they have reached the peak of their business.
Yeah.
I think all they're doing is really thinking about the current marketplace and what they need to do to stay relevant.
Yeah.
And continue this pace of growth going forward.
It's a good problem to have. You've become so large. You've gotten so many divisions. How do you create? When you own companies, what you want to do is own companies that can create value for you. And Constellation is thinking about these things. All their management owns shares in the company, right? And they're thinking of ways to try and incentivize some of their employees to. Maybe you want to get into that detail because I found it interesting.
Yeah, so that's another aspect that Constellation has spent a lot of time thinking about relative to other companies, which is how do you incentivize the employees to stick around and be happy while being fair to shareholders and not diluting them through stock-based compensation and all those kinds of things.
Yeah.
So historically, the way Constellation's bonus works is that you get your bonus based on your performance, and then you have to invest 75% of that bonus into Constellation stock.
Okay.
And if you work at Topicus and if you work at Lumen, then that would be what you invest in. Mm-hmm. But I think as Constellation as a whole has grown and the performance of the overall company has less relationship to every individual employee's work, I think they've needed to find ways to make sure that you feel like your work is contributing to your bonus and the performance of the stock overall.
That's right.
And so one of the things that they've started experimenting with is instead of you putting your bonus into Constellation stock, you're allowed to purchase shares of the companies that you are acquiring.
Okay.
So if you're the business unit leader for the pulp and paper software, then that's what you're going to be. You're going to be able to participate in that equity. So they're just experimenting with that right now. They don't know if it's going to work, but really happy that they are at least thinking about this problem as well again.
And one of the other concerns is, of course, the copycats. Every week or so you hear about another company starting to acquire software companies. Even Brookfield wants to get into that business. You've got private equity. You've got former Constellation employees leaving Constellation. They've already become super rich. They're like, I could do this. I can acquire companies. I can raise capital. I've got the name. I've got the database,
and I can charge fees.
And you know what? I can even pay a little higher price than Constellation.
Yep.
So what's Constellation's pushback on the copycat argument?
Well, I think they said that yes, there are copycats, but there's always been competition for deals, and I think that the thing that they've noted is that for the types of transactions that they do, which are either the owner-operator software company that is trying to sell to a permanent home, or very complex corporate carve-outs where there's a troubled division inside a large company that the company doesn't want anymore, but it's a lot of work for Constellation to extract out and turn into a standalone company. They've done a couple of these. This just business as usual. There's not any materially higher competition from copycats or whoever for those types of deals.
One of the exciting things, and you and I have talked about this not on the podcast, or maybe we have, is the fact that Constellation can now offer shares, right? Not the parent company, they're not diluting there, but let's say Ernest has created a fabulous software business. He knows it's going to continue to grow, but he wants to take some chips off the table. But he doesn't want to pay tax on, getting $100 million and paying a huge capital gain. So Constellation say, well, we really want your software. We really want to buy you. You do the same thing as our Jonas division.
Yeah.
Maybe we're gonna let's spin off a portion of that, merge with your company, give you shares. And because you are a smart guy and you've seen how the last two spinoffs of companies from Constellation, their share prices have done. Lumen went public in low teens. It's now $48. Topicus went public. I think it's $60 a share. It's now $170. You're like, wow, I can merge with these guys and maybe make even more money. And so that's something that you can offer large deals versus a copycat who doesn't have that ability.
Yeah, and I think this is the last thing that Constellation has going for it is really the best practices and the culture that they have of sharing the things that they're learning at all of their businesses. So, and that's relevant for AI as well, because all of the businesses in Constellation are experimenting with AI. Mm-hmm. They're testing it for customer support and like rewriting their code and doing add-ons with AI and all these kinds of things. And then they're able to share notes and compare and see what they're seeing in the marketplace when they do these experiments. And I think that's a really underrated thing that is hard to replicate if you're just starting up a private equity firm to buy 2 or 3 software businesses.
For sure. Anything else we missed that you thought was interesting, or any tidbits from the meeting?
No, I think wasn't like.
Is Mark Leonard going to retire anytime soon? Did anybody ask him that? How old a man is he?
I don't know.
Yeah,
but I don't think he is planning to step down anytime soon.
So he's not going to pull a Warren Buffett on us?
No, and I think the difference between Constellation and Berkshire is that the way Constellation is set up is so decentralized. It's not that Mark Leonard is himself evaluating deals all the time. It's largely the people at the business unit level that is evaluating deals. And so even if, like, God forbid, Mark Leonard got hit by a truck, like, I think the business would be fine, like, because the culture is there. Everybody is going to still be out there doing deals. Maybe you can separate out all the different business units as standalone companies.
So Ernest, it's 5 years into the future. What does the Constellation business look like versus today? No changes, more spinoffs. What do you think that happens in the next 5 years?
I think you're certainly going to see more spinoffs. I have my guesses on which verticals that might be, but I'm probably won't share that for today. We'll see what happens. I think that you may see a major spinoff. So maybe one operating group itself carve out itself again. Mm-hmm. So we already saw that with TSS. Yeah. Maybe you'll see that again with one of the operating groups. But I think by and large, it'll be business as usual. You might see, I think the next few years will be interesting to kind of look at the results of the experiments that they're doing. So Topicus, for example, they experimented with, like, they're experimenting now with buying like a Polish company that is like a mini Constellation of Poland. Mm-hmm. And they want to see but they don't have control of this. So they want to see how that works out.
They say they're not going to buy more than 25%.
I don't remember the exact share percentage, but yeah.
So they bought a chunk. They're trying to buy another chunk. They need regulatory approval. If that goes through, I think they're going to own a material stake, but not control. And the goal is to share information as well as get access to the potential growth for this Polish version of Constellation Software.
I expect they're going to do more large deals. Mm-hmm. That'll almost certainly be a focus area. Mm-hmm. And I think we're going to see how these new compensation schemes play out.
Mm-hmm. Very good. So let's talk about one more amazing capital allocator before we say goodbye, and that's Bruce Flatt at there's not too many of these guys. I tweeted, don't be so sad. Let's be sad that Buffett is retiring, one of the best of all time. But there's still some pretty good guys and women that can allocate capital and running companies that have yet to retire. And,
Bruce Flatt is going to retire.
Yeah, but he's going to move on to chairman.
Right.
Yeah, Bruce Flatt has already made it clear that he is going to hand over the reins of president.
Yeah.
He's still a youngish guy, but he's not going anywhere.
I don't even know if he's married.
He is married.
Okay.
So Bruce, his company Brookfield, as well as all the other spinoffs, what have you, reported a very strong quarter. Recently, the company highlighted that had you just bought Brookfield 30 years ago, left it alone, you would have compounded your portfolio or your investment in Brookfield at 18% a year. It's incredible. Yep. And he writes an amazing letter, right? If you miss Buffett, Bruce's words are just as relevant. The way he explains how to allocate capital, how they do it, how to ignore the noise in the market. He didn't spend a lot of time talking about the tariffs and the uncertainty. He's like, this could be good for us. We're going to be able to buy more companies at cheaper prices, and we've got we've got a great balance sheet. We're in great shape. We've got a lot of assets that are protected against inflation and recurring revenues, and the stock is, obviously performed very, very well recently. So, any thoughts or takes from Brookfield's most recent earnings?
Yeah, I think the concern going into the earnings, especially for the asset manager, was that private credit and private equity activity was slowing down because of what's going on in the world.
Yeah.
And especially, I think there was some concern that institutional investors were maybe a little bit less interested in allocating capital to alternative strategies like Brookfield's funds. I think they said that's not true.
If anything, there may be more allocation, right? Because of the volatility of stock markets continues to make retail and institutional investors nervous.
Yep.
The fact that these private assets don't have volatility, may even lead to more dollars flowing that way.
They had a really good quarter in terms of raising capital for their real estate fund, the flagship real estate fund, which was impressive considering the current state of commercial real estate. And they think that they think that things are just business as usual. One thing that they did do was they had a big quarter of share buybacks, which they typically do when they think the share price is cheap. So that's another thing.
And they're buying back stock. Bruce Flatt and his team own 20% of Brookfield. It's in their best interest to buy back the shares if they think they're trading at a deep discount. And it's true. Brookfield does trade at a discount, but more importantly, it has to grow the net asset value. It has to get growth from its assets. And I think that's working out well. It's, they're very excited about their insurance annuity business. It's still really at the ground stages, but they expect it to be a large contributor to earnings going forward. And of course, if strong results continue, there's a lot of performance fees that are going to hit the income statement over the next...
Yeah, the carried interest, which goes to Brookfield Corporation.
It goes to Brookfield Corporation, which ultimately will go to shareholders in the term of higher dividends or maybe share buybacks or acquisitions. So, the tariffs have made everybody nervous. But for most of the companies that we own, you read all, for those that do conference calls, very few companies are worried about these tariffs. Most of them are saying business as usual. There may be some pockets of weakness. CCL Industries is another company that reported earnings that said, well, the tariffs could actually be good for us.
Right. Yeah. In the case of CCL, it's because the reason it might be good for them is because they have plants in Vietnam and in Bangladesh that service the apparel industry. So they think that to the extent that apparel companies want to shift out of China into these countries, they might actually pick up some business.
That's right. But in the meantime, of course, Trump has made at least a 90-day deal with China to have much lower tariffs. Still tariffs, of course, and that may affect business profits and may affect the economy, but certainly not embargo like it was a few weeks ago. So that's a sigh of relief, and that's probably why you're seeing your portfolio recover and obviously we're very pleased that the market is now positive year to date, though that could change at any time.
Yeah, I think you never want to. I think if there's anything that you've learned from the last, even like half a year, is that you never want a victory lap, like a correct market call.
No.
There were how many people were kind of quote unquote celebrating when the market tanked because they were right that the market fell, but then before you were finished patting yourself on the back, the market had already rallied back to all-time highs.
Well, we told clients and whoever would listen that the last 5 years on the markets have been very, very strong, probably extraordinary. And, you can't have 2 years in a row of 20+% returns without some volatility after that, right? It's not how markets work. And so whether it was the tariffs, whether it was the uncertainty with who knows, it was a pullback, a correction was bound to happen, and there'll be more in the future, right? It's you don't need to hear us talk about that stuff because we talk about it all the time. So I think we'll end it there. But I really want to cover next week, Ernest, great capital allocators again in other industries, right? And we had tremendous news from Tourmaline and CNQ. Tough environments for energy prices, especially for oil, yet record production, companies keeping their costs under control, even lowering their costs, guiding for strong production growth. Right. It's great to be in wonderful businesses like a Moody's or a FICO or a MSCI who have just an awesome business model, but it really helps if you're a partner with great people who in a crappy business who know how to get things done, who know how to keep costs low, who know how to allocate capital. Just a wonderful combination of those two things is great.
Yep.
That's it. We'll see you back here real soon. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.